Money FM 89.3, the best of the afternoon update. Market View on Money FM 89.3.
Good Tuesday afternoon to you. It's Lindley with you. Now, Asian stocks tumbled today, led by sharp declines in the tech sector as markets tracked Wall Street's overnight sell-off amid mounting recession fears in the U.S., fueled by President Donald Trump's trade policies. Stocks fell as concerns about the U.S. economy tipping into a recession grew. The Dow gave up nearly 900 points. The S&P fell 2.7%, and the Nasdaq Composite tumbled 4% as shares of big tech companies extended their sell-off. Tesla stock lost 15%. Shares of the other Magnificent Seven stocks, Apple, Microsoft, Alphabet, Amazon.com, Nvidia, and Meta platforms fell between 2 and 5%. Wow. Here to help us unpack all the action in the U.S. is Yeap Jun Rong, market strategist from IG, who joins me now. Great to have you on the show again, Jun.
Hey, good afternoon, Lily.
Now, let's start with the big picture. What's your take on this? And why did the U.S. markets take such a big hit today?
Yeah, kind of a bloodbath, isn't it? I think overnight we have seen that huge sea of red across U.S. indices, particularly the Nasdaq, down 4%. And that really overrides for all of Friday's deep buying activities. I think our headlines are pointing to the dip below that key technical levels of the 200-day moving average for the S&P. So I believe there could be some technically driven kind of a sell-off that sort of amplify the recent jitters. So in a way, I think what markets are pricing at the moment are two things. One is in terms of higher recession risk, or probably a small part of it, even stagflation risk, brought on by expectation of more U.S. trade tariff to come. And my view is that, for Trump, who previously viewed the stock market as this barometer for his success, to really come in and say that the economy is in a period of transition, in a way, it highlights the fact that, he's willing to tolerate some near-term pain. But also it highlights the fact that he will not compromise on his aim to push through tariff just because the stock market is dipping. So that seems to be a change in the stance from what he has displayed back in 2018. And this is definitely not what investors want to hear. And we are seeing it play out in terms of de-risking the market. Because the other risk is in terms of the tariff risk. If it's not backing down, there's the risk that there could be more tit for tat retaliation between our trading partners. So that will drag on global growth.
So do you think this is the start of a pullback or just a temporary blip? What are the technicals showing?
Yes, I think if we were to see this as a temporary dip, I will argue that we really need to see more buying pressure step in over the next week to really push back and reclaim that 200-day moving average. But if you were to see it fail and, if you were to see a prolonged kind of a trade below that trend line, then, I'll argue that, there could be a further extension of this sell-off. Nevertheless, things are getting a little bit shaky. I'm still looking for some of a near-term tactical bounce. But of course, with the current dynamics, we have somewhat formed a lower low based on its previous price action. So with any rebound, the key risk is that if it were to form a lower high, then, that could mean that the near-term downward trend may continue. So we really got to see how the buying pressure will really step in over the next week. Okay,
I'm just going to ask you for your view, okay? Observers, experts are all calling this a Trump session, fears of a Trump session. So do you think it's likely that this is the outcome Trump had intended as a possible solution for inflation?
Yeah, that's a very good question. Of course, the debate now is whether it will really be a Trump session or it's just a scare, like a recession scare that we have seen back in early 2023. My view is that, Trump wouldn't want a recession, of course. And of course, I believe the recession narrative could still be overblown in my view because I think, number one, we haven't really heard of Trump's tax cut policies yet. He has started off his policies on the tariff footing. Thereafter, we should hear more about deregulation, hear more about some of the tax cut, which tends to support risk-taking. And secondly, if you look at some of the economic data, last Friday's jobs data, I would argue that it's kind of resilient, even though it's turned in a little bit softer. But, unemployment rate 4.1, there's still, close more than 100,000 job gains. That is comparable to pre-COVID kind of economic conditions. So it hasn't really shown much of a recessionary risk yet. Services PMI also shows a stronger expansion in February. So looking at the current scale of decline, to me, it does seem more of a sentiment-driven move rather than one that is really backed by, a plunge in those economic data.
Jun Rong, last night's sell-off in the U.S. markets, which sectors are holding up amidst the sell-off? And not just last night, but in this couple of weeks. I know tech sectors were worst affected.
Yeah, sure. So definitely U.S. tech bore the brunt of this sell-off, and investors are really revisiting their valuation and seeing, with U.S. growth potentially slowing, whether they can still justify that valuation. So investors are not taking any chance on that. What we are seeing is a shift towards the defensive. So utilities, energy held up. And if you drag the time frame over the past week, we are seeing also some of the defensive like healthcare, consumer staples, also showing some form of a resilience compared to growth stocks. And we are also seeing some uptick in terms of some buying in terms of U.S. treasuries, gold, somewhat still weak, but, I would argue that it's more resilient and people still look at gold as this very good hedge against all of this trade volatility. Of course, defensive currencies like Japanese yen, Swiss franc are also seeing some form of attraction here.
Okay. Now, with Wall Street reeling, let's talk about the spillover effects. What can you tell us about how Asia is reacting?
Yeah, with that sell-off in Wall Street, clearly that is going to have a negative impact on Asian markets. Even though I would argue that the scope of decline for Asia may be more contained, given that the previous run-up has not been as strong as the US. And of course, there is lesser composition of growth stocks in the Asian region. And growth stock has clearly been that key drag on the US markets. And looking at the current performance, yes, a sea of red, but in a way, some stability has sort of returned. Some pairing of losses that we are seeing into the second half of the current session. So U.S. futures also inching into a green, so, some potential, some room for some stability ahead. But of course, I would argue that it's more of a cautious optimism, given that we still have reciprocal tariff to look forward to on the 2nd of April. That is a key risk to digest. And for export-oriented Asian economies, any form of a reciprocal tariff that is not going to be good. It does mean that, there will be slowing global trade activities, there will be higher consumer prices, there will be higher business costs if firms were forced to re-navigate their supply chain. So in a way, there's still a lot of uncertainty, but of course, near term, given that strong sell-off, there could be some room for near-term stability.
For investors watching this market turmoil, what do you think is the best approach right now? Panic selling isn't the answer, obviously, but should they be making adjustments?
I would argue that in a way there are some form of a capital rotation out of the US, given that strong performance that they have delivered. So, any form of a growth jitters, we have seen this very strong profit taking, this very strong unwinding. And I believe that investors will be seeking out areas of value to park this capital. And where do I see it? I'm still positive on Chinese tech. I believe that even with that recent surge in the Hang Seng Index, more than 30% of the past month, that surge in that Hang Seng Tech Index as well. I still see several positive growth factors in terms of, AI advancement, really driving this upward earnings revision. And of course, Chinese authorities stepping out to give that reassurances that, there are more policy support in place. Of course, our Eurozone are also another one to watch, because the thing here is that China and Eurozone policies are turning more supportive, which stand in contrast with the US, which is currently tightening its belt. So I think our investors will want to seek out for areas of opportunities in those areas.
Speaking of which, you mentioned earlier reciprocal tariffs April 2nd. What are the key events or data points investors should be watching? What else should we be watching in the coming days?
Yes, so I think definitely a lot of a tariff headline, but now we know that Trump is being tough on his stance. So that means that the path towards some form of a resolution in the near term seems to be narrower, but of course it depends on with that huge sell-off that we are seeing in the markets, whether much has already been priced in. Ultimately, the 2nd April timeline will be that key to watch. I think he has mentioned that, there will be sort of one tariff rate for each country. So clearly he's scrutinizing all of the trade surplus that these trading partners have been running with the US, and he wants to deliver somewhat of a proportional kind of a strength, kind of a reaction move. And therefore, I think some of the Asian economies could still see some form of a weakness, particularly in Vietnam. also South Korea, Japan. Those are some of the countries that could face some form of a reciprocal tariff in that sense.
Jun Rong, always good to hear your views. Thank you so much for your time today. Yeap Jun Rong, market strategist from IG.
Thank you, Lily.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.